Hello, and welcome to myfinanceteacher.org. Recently, I got a comment on YouTube asking me about the relative performance of gold price between mid-2016 and nowadays, basically, or late 2020, and IAG as well as EGO. In this video, we're going to have a look at IAMGold IAG. After all, within the same period, gold price has actually increased by over 35%, whereas IAG has done relatively well in 2016 and 2017, but since then came down quite a lot by the end of 2020. So similar to what I do in my valuation videos, let's have a look at the fundamentals of the company to see if we can find some reasons for relative underperformance of IAG versus gold price itself. And secondly, besides the fundamentals, we will also try to have a look at market sentiments, something like greed versus fear, specifically on IAG, to see if the market sentiment also might have played any role in this underperformance in IAG lately over the last, say, couple of years. So starting with the market fundamentals, which, let me remind you, generally would affect the share prices of the gold miners over a longer period, because in the shorter term, the market sentiment might actually move the price around away from those fundamental values for quite a while before the share price reverts back to those fundamentals. By the way, before we jump in, today is 22nd of January 2021, and if you are watching this on YouTube a couple of weeks later with a bit of a delay of a couple of weeks, and if you want to have timely access to all of my detailed analysis, join us at myfinanceteacher.org. You can join by clicking this register button. It's actually hidden behind the webcam. The first month is only $5 and it's $10 per month after that. So looking at the fundamentals, these are the factors that I usually look at when I try to find a more or less fair value for the share price. We are going to compare the fundamentals between mid-2016, that was the peak of the gold price, around $1,370, and nowadays the price is, let's say, somewhere around $1,850, call it end of 2020 or early 2021. And of course, in addition to gold price, we're going to have a look at the resources that the company has in the ground, the cost of extracting those resources, the debts that the company has, the amount of shares outstanding it has, how much of those shares are in the insider hands, as well as the time value of money. How long will it take to extract those resources out of the ground? So between mid-2016 and late 2020, the gold price has actually increased by around 35%. We have change here, and sometimes positive change is a good news, in which case I color the good news with green color, but sometimes a negative change is a good news, such as a decrease in the long-term debt. So green color over here shows an improvement, and red color over here shows some deterioration in these factors. Now, going through each of these factors, we see that the proven and probable reserves that the company has more than doubled from 7.3 million ounces back in the middle of 2016 to 15.6 million ounces more recently. At the same time, half of measured and indicated resources dropped from around 7.9 million ounces to around 5.2 million ounces. That's a decrease of around 34%. So on one hand, we have proven and probable reserves more than doubled, whereas the measured and indicated resources, or half of those, as I only include half in the valuation model, decreased by around 34%. Don't be misled by the relative size of these numbers. 114% is not actually 3 times as good as a decrease in 34%. Because looking at the total resources, proven and probable, as well as measured and indicated, we see that back in the middle of 2016, the company had somewhere around 15 to 16 million ounces, whereas more recently, the company has somewhere around 20 to 21 million ounces. So that's an increase of around a quarter. So generally, all of the resources that we include in the valuation increased by around a quarter. At the same time, however, all-in sustaining costs have increased by around 20%, so it became much more costly to extract those resources out of the ground. As gold price improved, the company has paid back quite a lot of its debt, which decreased by around 25% between 2016 and 2020. However, a big negative sign here is an increase in the amount of shares outstanding. As I've mentioned in one of my previous videos, although fundamentals might point to you that a share price is undervalued, the future performance might still depend on what the management does. So if the managers dilute the shares too much, that of course will lead to underperformance of this particular share. In this case, the shares outstanding increased by 16%, increased by over 66 million shares. So that dilution, of course, would add to relative underperformance in the share price. Looking at the insider shares, I didn't actually find the information for mid-2016, so let's assume there was no change. Hence, the main point here is that generally the percentage of total shares held by insiders is relatively small, only at 1/4%. And lastly, average mine life, or the total resources, both including proved and probable and half of measured and indicated resources, in years was around 19 years for mid-2016, and now it's greater at 32 years for late 2020. That would actually be considered as an improvement for many investors. However, in my particular valuation model, it simply means that it will take us longer to extract those resources out of the ground and turn them into cash, turn them into profits. And because the model takes into account the time value of money, that actually reduces the valuation. So the increase in the mine life by 68% has also added to a reduction in the valuation by a noticeable amount, because the discount rate I use is quite high at 5%. Still, with a much higher gold price, the valuation predicted by the model should be somewhere above $23 by the end of 2020. That is basically the value of the resources in the ground after all the costs, whereas the valuation predicted by the model back for mid-2016 was somewhere around $6.6. The market price at the end of 2020 is moving somewhere around $3.5, which is quite far below the valuation based on this model, whereas the market price back in mid-2016 was much closer to the model valuation at $5.6. So while the valuation has actually improved by 262%, the market price has actually dropped by 38%. So besides the fundamentals, something else is at play here, because despite all of these red colors, model valuation has improved, whereas the market price has dropped. So either market sentiments do have a role to play in share prices, or there is some additional information that we should include in the model. Talking about the market sentiment, I think it's a little bit unfair to compare the mid-2016 with late 2020, because mid-2016 coincides with that peak, a local peak, both in gold prices and in the share price of IAG. Whereas for 2020, the peak prices were somewhere in late summer. So let's instead compare the valuation in mid-2016 with mid-2020. And in that case, what we're going to see is that the model valuation doesn't really change substantially for the middle of 2020. The model valuation is somewhere around $25. But the improvement is in the market price. When you compare peak versus peak, you will see that the price has actually dropped by only around 7% rather than 38% when you compare peak versus a current local low on the prices. So that shows you the effect of market sentiment with not much change in the market fundamentals. We see that the price has moved from $5.2 down to $3.5, with the market sentiment dropping quite a lot. So comparing peak for peak mid-2016 to mid-2020, we see that underperformance of IAG is substantial, but not as substantial. The price has dropped by around 7% between the peaks. So having seen the effect of market sentiments, let's try to have a look at a measure of market sentiment based on standard deviation. What I have over here is the price of IAG, that's the weekly price, and this is the blue line. That's the weekly price of IAG for 2016. The lower gray line is the level which is one standard deviation below a monthly average of the price, below a 4-week average of the price. We see that's 4-week average minus standard deviation over the last 4 weeks. And the upper brown line is that same 4-week average, is that same monthly average plus one standard deviation. Whenever the price is above its average by over a standard deviation, you might say that the markets are somewhat excited. Whereas if the price is below average by over a standard deviation, such as over here in spring of 2016, you might say that the markets are possibly somewhat fearful. So generally what we see over here on the sentiment reading for 2016, we see that especially in the first half of 2016, the price spends most of the time near the upper range of this monthly average plus one standard deviation. And even in the second half of the year, when gold was dropping together with the share price, the price still spent 1, 2, 3, 4, 5, 6, 7, 8, 9. Around 9 weeks near the average plus standard deviation. So back in 2016, it seems to me that the general reading was towards greediness on the markets rather than fearfulness. Compare that with 2020. Again, the blue line here is the price. The gray line underneath is the monthly average, 4-week average minus one standard deviation. The brown line on top is again that monthly average, 4-week average plus one standard deviation. We see that all through 2020, the price has never actually touched that upper line. And it has actually even poked below the one standard deviation quite a few times, one time quite deeply over here in March last year. Of course, after that there was a nice push higher from under $2 to nearly $4 first, and then to around $5. But even with such increase, it seems to me that the general reading for 2020, although the gold price has actually increased quite a lot between these years, still the general reading on IAG seems to be more fearful rather than greedy. So my next question here would be, is it something particular about IAG that I'm missing, or do we have some problem with the gold miners? Comparing IAG, the red line over here, with GDX, the blue line, we see that back in middle of 2016, both GDX and IAG did perform quite similarly. After that, in 2017, IAG was actually outperforming GDX by quite a lot, and perhaps that outperformance is now leading to some cool-off period when IAG is not gaining as much as GDX does over the last year. So if, let's say, sometime in 2021, IAG manages to catch up with the performance of GDX, that might actually be quite profitable. That again depends on the managers, if they don't dilute the share price a little bit further and don't get too excited with higher gold price increasing their all-in sustaining costs. In either case, you know that I'm still holding IAG in the fictitious portfolio, as I think gold together with the miners are ready to push higher into the continuation of the rallying stage of the ongoing intermediate cycle. And that concludes this analysis. Next time we're going to have a look at Eldorado Gold. Before then, let me know what you think of this type of analysis. Share your opinion in the comments below. And for now, good luck in your trades.